Some investors are drunk off yields, and this may not be the opportunity for them. What I've learned from that is communication is everything. Being able to communicate with your investors through the good, bad, and ugly, they really appreciate that. Every 30 days or every 3 weeks, good, bad, and ugly, you should have a communication piece going out. Here's where we are with occupancy. Here are the challenges we faced. Here's how we overcame them. Here's what we didn't overcome. Here's what we're doing. I think that's what's most important.
Investors and operators, welcome back to the Invest Clearly podcast. I'm the CEO of Invest Clearly, Pat Zingarella. In this GP episode, Chief Strategy Officer of Invest Clearly, Joe Guidi, sits down with Fuquan, founder and CEO of NNG Capital Fund. Fuquan walks us through how he transitioned from single-family fix and flips to building a fund structure focused on notes, multifamily, and tax lien strategies. He explains how his capital raising approach has evolved, how he manages LP expectations across different deal types, and what communication practice he uses to address investor concerns during market turbulence. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Fuquan, thanks for joining me.
Appreciate it. Thanks for having me, man.
Yeah, excited to have you on. I know you've been on the platform for a while and, wanted to take some time to connect with you here.
Yeah, I'm enjoying the platform. It's the Google of investments. So
yeah, we're getting there, not quite Google status yet, but yeah, we're moving that direction. So, thanks for joining me. I want to start out just for any of our listeners who might not be familiar with you, would love to have you introduce yourself, tell a little bit about your firm.
Yeah. So Fuquan Bilal, NNG Capital Fund. So the company is 13 years old, but I've been investing in real estate since 99. It's been a 26-year journey, kind of jumped out the window and grew wings falling down, if you will, back then. And, went through the GFC, the dot-com boom and, bust, and also, COVID and everything else. And what I've learned from that is communication is everything. That's kind of what I learned on my journey, that being able to communicate with your investors through the good, bad, and ugly, they really appreciate that.
Yeah, definitely. I mean, we're hearing that loud and clear from investors. I'm sure you've seen some of the reviews on the platform. Like, communication seems to be the key to investor sentiment, good or bad, to your point. So talk to me a little bit about, I know we were talking, you recently moved into 506Cs. So bringing in investors, theoretically, you're bringing in new LPs from different sources, like maybe outside of your network. I'd love to talk a little bit about the evolution of your firm, like how you got started in raising capital and how that's changed over time as you've kind of shifted towards accepting capital from people outside of your network.
Yeah. So I started off dealing with hard money, right? Like the typical fix and flipper, dealing with hard money, building out my track record from there, then friends and family. And my biggest investor was actually the owner of a building that I was leasing, right? I was a tenant in a building, and the owner would see contractors coming in and out. And he actually had some success in the dot-com boom, and he cashed out before the bust. So he had money. He started to deploy some of that capital into real estate. He started to leverage lines of credit. And he had a conversation with me one day and was curious about what I was doing, because he kind of saw the contractors, a bunch of movement. He knew I was a real estate firm, and he gave me an opportunity and started to invest alongside of me on projects. Still was kind of sort of like hard money, but it filled up the gap, right? So I would have the hard money lenders give me 75% and the draw for construction. He would come up with some more of the money to kind of give me the ability to do multiple projects. So and then it was his friends got involved, and then it was a network of people. And at that time, it was just the traditional way where you just put a first and second mortgage on the property, right? And then, we had the global financial crisis where things got out of control. I had to liquidate a lot of the assets. And what I was alluding to earlier, that communication is important, because I was able to stand up in front of my investors and let them know, look, we're going to have to fire sell everything. I'm not going to file bankruptcy. I'm going to make you guys whole. We're going to get through this, but it's going to take time, right? And they were very grateful for that, because back then people was just, not communicating at all, filing bankruptcy, running for the hills. It was a disaster. And it was like it was common. So it was acceptable, right? Because it was like everyone's going through it. The world was coming to an end, so to speak. But getting through that process over 2, 3 years, I transitioned to learning how to buy notes. And that came accidentally from doing short sales, because short sales back then was booming. So I transitioned around 2009, doing a lot of short sales 2010. And I had discovered the note business by being on the phone with a negotiator. And he had asked, why don't you just buy the note? So doing researches of notes, I kind of stumbled across a hedge fund that was actually selling notes and became inquisitive. And it's a funny story. And I always tell the story. I remember my son at the time asking me, why don't you just become the bank? And I was like, that's impossible. Dad, I thought anything is possible. So I was like, okay. So I started to research that and consulted with an SEC attorney, put him on retainer, and learned a lot. And back then there were so many shops like there is today. One-stop shop. We'll help you set up your PPM. We'll help you raise capital and all this blah, blah, blah. I actually like the version of going directly to a SEC attorney, explaining what you're trying to do, letting them teach you, $5,000 retainer, get you like 10 hours, right? And you can learn so much during that process. And so I set up a fund to buy notes in 2013. And that was my first fund, friends and family. It was non-accredited at the time. I remember my cousin invested with me. It was like a $10,000 minimum every time I see him at every family function. Is everything all right? Did I make a return? Am I going to lose my money? So going from that evolution to like, you know what? I'd rather deal with people who's a little bit more sophisticated, who understand investment. Right. And it's an evolution, right? So you start off with that. And today, we raised more than $50 million dealing with just accredited investors. It's a mindset challenge, thinking that because those people are not in your circle at first, that you won't be able to attract those dollars. But if you're knowledgeable and you have a track record of what you do, and you talk and you walk the talk, so to speak, people can see, right? They can sense that you have this experience, that you have this track record, because ultimately, I believe, it's really based off of the operator, right? What are they going to do when things get tough? How are they going to communicate? Do they have the track record and experience? Because people are eventually investing in you, right? The sponsor, right? So regardless of how good or bad the investment is, nothing is perfect. What is the sponsor going to do when, things get tough?
Yeah, I think that's something we're hearing a lot on these. I'm hearing a lot from other operators is like the most important thing is giving LPs a sense of what happens if and when, or when and when or if things go wrong, and how do you handle that? So you talked about track record, you talked about communication, you talked about your cousin, which is obviously we have this kind of people who know us, maybe invest with us early days, taking a shot on us. They've known us forever. What I'm wondering about is like, for someone who hasn't invested with you, obviously you can show them your track record, but how do you give them a sense of how you're going to communicate with them?
Yeah, I mean,
prior to investing,
it's a nurturing process, right? So it's all education. People got to get to know, like, and trust you in that order, right? So I can talk what I do, right? Some people are good marketers, right? Some people get online, they have all this marketing. You see them all over the place and Facebook feeds, and they got their little Canva artwork done, and some people are just great marketers. But you want to invest with the doers, the people who are actually doing, right? So for me, I'm a boots on the ground operator. So a lot of the things that I do to kind of build that education process is showing investors what I'm doing. I'm not just telling you what I'm doing. I'm actually showing you what I'm doing. I'm out in the field at one of my projects. I'm educating you on how I underwrite deals. I'm giving you case studies, real case studies that you could go online and research on your own through the Zillow records. When I purchased it, how much I purchased it for, when I sold it, how much I sold it for. All that is public information. So if I'm giving you that data and you're an intelligent investor that's going to do due diligence, right? You're going to figure out like who's the real deal and who's not. So, going through that process of education, webinars, there's so many, 10 to 16 hours of content, videos, messaging, whatever, education. The investor is like a song you hear on the radio, right? You hear it over and over again, you start singing it, right? So through that process, it's nurturing the investor to kind of get them to making a decision whether they're going to invest with you or someone else. That can take years. I've had investors that's watched me for years and go, hey, I've been watching you for 3 years. I met you at this conference here and here. I want to test you out 50,000.
Yeah, I think that happens a lot, honestly. Sometimes the cycles, like the investor's journey, it gets viewed kind of on too short of a timeline for many, or we want it to happen faster than it actually happens. So are you buying distressed debt? Walk me through what are you
Well, today
investing in?
our model is a bit different. We have two verticals now. Before COVID, we had three verticals. One was
Okay.
distressed debt that we would buy. And after COVID, we kind of pivoted from that because, you were the bad guy foreclosing on people. And it's
Yeah,
like, you can't really control a homeowner unless you foreclose, right? If we foreclose, we fail. The model was to get the homeowner back on track so we can be the bank, right? And we can share our discount with them and that whole thing. And we did the note business from like 2010 all the way. I kind of stopped that a bit, like right after COVID, and focused more on multifamily. We found some great opportunities in the Southeast, and we started to divert the capital there. A lot of the rental stuff we was doing here in New Jersey, where I've been investing for the last 26 years, but after COVID, because of the blue state, it was more tenant friendly than landlord friendly. So we kind of divested the portfolio, especially when New Yorkers started to come over and values were 30% of a list. We said, hey, I knew from experience that we would never see a market like this again. It was like a dead cat bounce. So
sure.
let's just offload these smaller 2 units, 3 units, 6 units, 10 units, smaller multifamily and go for bigger multifamily so we can do our impact, which is I come from the hood, the ghetto, whatever you want to call it. So for me, my feeling of importance is going back to those communities, revitalizing the area, putting them back on the tax roll, giving the residents a better place to live. I get to stick my chest out and go, I've made a difference here, right? So taking community from complex to community, right? Not only making a difference on how the grounds look or curb appeal, the mindset of the people there, extra programs you can be doing, teaching them how to do their resumes, like that whole thing. I'm really into that because I come from that. But transitioning the portfolio down there to do renters on a larger scale is what we pivoted to. And we do luxury spec homes here in New Jersey. So those are the two verticals. Luxury spec homes in New Jersey, where we do ground up or additions with a luxury product at the end, and multifamily in the Southeast. Those we could control, right? We can make sure we hire the right people. We can give them the proper training and support. We can do marketing to try to increase occupancy. So many things that we have more control over versus the note business. See, it's the human on
Got
the
it.
other side.
Got it. Got it. Yeah, that makes total sense.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
So I love the impact investing focus. How do you handle? And I'm not maybe you're not sure if any of these you've gotten into any cycles like this where you're in the process of stabilizing. Maybe the numbers aren't right where they should be. And again, I'm putting out a scenario, so let me know if this doesn't resonate. I think most investors that invest in kind of like impact investments like love the idea of it. But then if the growth happens slower than they want it to, or like the numbers aren't on pace, it can get to take a little bit longer. I think we all think that the long-term impact of impact investing or long-term growth of an impact investment is good, right? It provides you a better, more secure future. But obviously you have to invest in that. You have to invest in kind of the community side of it. Have you ever had to like balance those things with your investors?
Well, I mean, it's purposeful capitalism at the end of the day, right?
Sure.
Is what I like to call it. And not everyone is for that. Some investors are drunk off yields, and this may not
Sure.
be the opportunity for them. So they're yield driven. They're trying to get the highest return possible. And I get that, right? It's true capitalism. So you have to be able to connect with those capital partners that is in alignment with the goal that you have, right? Your core values and everything else. And that's not for everybody. Some people are at different cycles of their investment journey. Some people are older where they need cash flow. Some people are younger where they need growth opportunities to get there faster, to retire from if they're a doctor, dentist, or busy professional, whatever it is, faster, right? So you will meet investors at different parts of the cycle, right, of their investment journey, and you will connect with those who have the same alignment, right, with the goals that you have. So it is tough. There are things you have to go through. If you're doing impact projects, you got to connect with the local municipality, figure out what they're trying to do there. There's deed restrictions involved, so you can get certain financing, certain benefits, whether it's from Section 8 or some type of housing that they have there. It's a lot that's involved with it, but there's benefits at the end as well. There's the impact to the community, which is the goal, right?
Yeah. Right.
We want to make money, but we want to make an impact more. And there's some people who have more of a purpose where they want their dollars to make an impact. So they're good with a 9-10% return, right? Or 12%, whatever. Some people need that 18%. So they're drunk off yield and they're chasing that 18% or 22% IRR that's being marketed. I've been in a few syndications. I think the best I've ever received was 11-12%, marketed at 22, but at the end of the day, it's like 11-12. I'm still happy. 7-8% is good for me. I didn't lose principal. I think that's what's most important. Capital preservation, especially now in this part of the cycle, is key, right? So
100%. Well, and I guess you have an offer for folks if they do want to just go pure capitalism. You can sell. They can do luxury real estate in Jersey, right?
That's, for sure. That we pay 12% all day, per annum. But that's a 24-month term, and basically when they cash out, they get paid, and they can chase those yields and be a part of that. And then what I've found is just depends again. With some people have money, so they're not looking to just make a bunch of more money. They want to create impact and preserve the capital as well. So if they make 9-10% of their money, is still more than they would make in a CD or, anything that's traditional.
Yeah, that's I think that's really interesting. So obviously, I mean, I keep coming back to this, so let me know if I'm off base here, but like I keep coming back to this idea that impact investing, I know some folks, I'm pretty close with some folks that work with like big impact investment funds, like more on the institutional side. And their argument is always like, well, if we kind of like make a better values-based investment in a company that has solid fundamentals, it's likely going to outperform in the long run. And is that kind of the same thing you're saying? It's like, well, if we stabilize the community, if we provide better living, you're ultimately going to see rent appreciation over time. You're going to see better communities. Is that part of it?
Correct. And they have to have at least a 7-year mindset. Like they have to have a 5 minimum 7-year mindset, because that's how long it actually takes to stabilize, to grow that asset, to get it where it needs to go. To be able to pass value on to the next investor, like leave a little meat on the bone, so to speak. There's been opportunities where investors came into an area, they got the deed restrictions, they went through the 7 years, and now the deed restrictions are almost up, right? Because whatever government money they got, they paid back or whatever. And they're passing the opportunity, the torch over to you to continue that, and leaving meat on the bone for you to continue that as well. So it just depends on what cycle that asset is in, if you're going to make the acquisition or not. In the beginning, I didn't understand it. I was like, why would I want to buy something where rents are restricted? And it was like, well, it has deed restrictions. No, I don't want to touch it. That's nothing, right? And I still had the mindset of adding value, but earlier on in my multifamily journey, I just didn't understand, the benefit of that. Now I do, right? Because there's certain funds that you may be aware of that give lending, especially for that. Like they got to check the box off. Like the institutional guys got to check the box off. Yeah, we're loaning to minorities. We're doing this, the CDFI, so there's a lot of opportunities even for minority owners, right? That I had to go through the discovery and go, oh, because I'm a minority, I can get this and get that and use it for impact. So just a lot of ways to slice it, but it's a long-term mindset. It's sort of like, I can't think of it now. What was the big thing that came out? There was a type of fund you could have in areas that was designated for certain things where people can defer taxes and
like opportunity zones.
Yes, opportunity zone. There you go. Thanks for your So when the opportunity zone came out, it was a buzzword. Everybody, how do we do it? How do we do it? Oh, it's a 10-year play. I don't know.
Yeah. Well, I think 10-year play, coming back to the theme of trust here, I think 10-year plays require that, right? You're going to lock up LP capital. They've got to believe, that you can do what you say you're going to do. So Southeast multifamily,
Yeah.
kind of like a little bit of a, maybe too far to say it's a hot topic, but it's coming up a lot right now, obviously. I'm sure in terms of values and rent appreciation, obviously your strategy kind of probably takes some of the concern away because you're doing this impact. You're going into lower income neighborhoods, you're stabilizing, you're building up, right? So maybe it's not as big of a concern as some of these like Class A or Class B plus multifamilies in the Southeast. But I'm sure you're hearing from LPs on this, like
Oh, for
wondering,
sure. We was
yeah,
just at Marcus Miller Chap. They had a Southeast Multifamily Conference a few months ago, and we were there hearing from the guys in the A to B, like you said, with the struggles and the challenges they're going through with whether it's fraud or whatever it was, like a variety of things that operators are experiencing. Our properties are less than 80% AMI. So basically, we're not there where we're charging an astronomical amount of rents. Our goal is to be $50 to $75 cheaper than our competition and still be profitable, right? So I mean, at acquisition, you have to really get a good deal in order for that to
right.
work, right? So
So you're underwritten that way,
yeah, it's underwritten that way. And plus, you got to think about the affordability of the people, right?
right?
We can say we're going to increase rents $25 every year until we get to our goal, but can that person afford it? Like at what point, especially if you're implementing rubs now that they never had rubs there, and you're now implementing that's an extra cost to them. And then now you increase your rents on top of that. So you have to be kind of mindful of that. But there are challenges, right? There's operators who have to be class, which they probably can afford, like living check to check, and they have amenities. So they're using amenities like weapons now. So we got to be very strategic and competitive on our marketing and everything to continue to draw the right tenant, right? That's going to get in there and pay rent long term because they can afford it, right? Because if
Right.
you're $50 to $75 cheaper than your competition, it's tough for them to have a mindset to go, I'm going to pay rent for 7 months and then leave. Like, where are you going to go? Like, you're going to pay more if you go there. So, I mean, then working our programs when something that we are getting good at, we don't have mastery in it yet, but tapping into the local programs, the Catholic churches and other different programs that give these residents that fall on hard time support, right? We learned a lot of that through COVID, like how to tap into the
Right.
municipalities and what programs they have, what paperwork need to be filling out the paperwork, sending it to the tenant just to sign, to review and sign, to get it processed faster. So we're starting to implement some stuff like that where we see some of the tenants are slow payers or paying towards the end of the month, jumping in there, trying to help them. It's work. It's a lot of work.
That's sounds like a lot of work, but that's really interesting. And again, back to the theme of building trust, I'm sure these are some of the things that you're positioning the LPs in your strategy that like if they did come with a concern, say, hey, I'm hearing a lot about Southeastern multifamily. How are we doing on value, so on and so forth. Like that's a very interesting roadmap for how to
But that's the
solve.
communication. Like,
Yeah,
at least every 30 days or every 3 weeks, good, bad, and ugly, you should have a communication piece going out. Here's where we are with occupancy. Here are the challenges we faced. Here's how we overcame them. Here's what we didn't overcome. Here's what we're doing. And then every 30 days, just giving them an update, good, bad, and ugly. I think that's what sets me apart from most sponsors is the communication.
so every 30 days, you're communicating with any LP that's in a deal, like what's going on. What level of reporting are you? Is it a summary view? Do they have access to financials? Like what depth of reporting are you or visibility are you giving to LPs?
So both. So we have an investor portal where they can go in and look at data. And it's just a summary also, whether it's me coming on talking or just a written summary, some form of communication, giving them high level, here we are. If you want to drill down, you go into the portal, but here's where we are with occupancy, rent collections versus what we were supposed to collect. Just, simple KPIs that makes a difference to them to show the performance of the asset. So that's kind of what we're just giving a performance of the asset and going, hey, we need to hit this target in order for us to do this, in order for us to do a refinance through HUD, which takes forever. I think someone said, I think pregnancy is shorter than HUD refinance. We can have a baby faster than a HUD refi. So the things that we need to do to target that, right? Because we had that tenant base there, affordable housing, So that falls all in alignment with that type of program for the government or whatever. So, we're constantly keeping them updated on where we are towards hitting a target so we can do that refinance to get, 80% of the value or whatever. And this is what we project the value to be once we're stabilized at this percentage, right? So those type of communication pieces going on, or if it's rehabs that we're doing to a particular project, because we had what's some smaller projects, because our goal is 40 to 150 units. So we pin them up against each other so management can service them. We find some really good deals. So the 40 units, anything less than 100 units, those are like shorter terms, like 3 to 5 years. We go in, change the community by helping to relocate those tenants who may have been at really low rents, and there's really no way to get them to where market is at because they've been in there such a long time and they're probably paying $450 for like a 1 bedroom that we know will go for $750. And unless you're going to totally renovate the unit, you really can't, get them there. So we'll reposition those tenants. We'll put them somewhere else, find a location for them, and then go in and rehab the property and then get it stabilized and then sell it a year or two after. So we'll keep them updated where we are with that as well. And that stuff have bridge debt on it. So we got to let them know the timelines of construction, which is very important, and how we're doing with that, to get to our goal to get stabilized and to fix that. So it's a lot. Multifamily it's a lot of work.
Yeah, no, that's without a doubt. And I think coming back to the consistency, I think if we come back to the key things you've said, it's like track record, communication. So like being honest about where you've been, what you've done, how you've performed, getting in there and communicating every step of the way with the LPs. It's been really great. I know we're kind of running short on time here. I want to make sure that our listeners know where to find you if they want to learn more about NNG.
For sure. I mean, if they want to go to our website, nngcapitalfund.com, they can go there, schedule a discovery call. I like talking to investors that, no matter where they are in their journey, if they're just looking for more information or looking to learn more about our strategy, they can schedule a discovery call and pretty much go from there. You can also check us out on investclearly.com.
Nice.
So
thanks for the plug.
Yeah. That's awesome. And I love the site because it gives investors who may not know you, who may be looking at other sponsors, right? They just happen to run across you and go, oh, okay, well, let's check it out. And it's third-party verification, meaning that someone has to actually be invested with you to be able to give, their opinion on their relationship with you. And that's what I like. It's just not, fake Google reviews where anybody can just come and leave a review. So I think that's the best thing I like about it, because you're hearing from real investors, right? So.
Well, thanks, man. And we like it. Yeah, we're glad to have you on there, and you've got some great reviews. So yeah, check them out on Invest Clearly.
Awesome.
All right. Well, thanks. Have a great day.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.